Trading sugar using CFDs. Commodities which are grown, like sugar, are called soft commodities. Those that are extracted are called hard commodities. There are a number of factors that influence the price of sugar. Government trade policies are the main influence on the price of sugar, but weather is an important factor too, making the price of sugar subject to sudden fluctuations. Over 3/4 of the total sugar produced is consumed domestically in the countries in which it is produced. The rest is traded around the globe, which is often termed as world sugar. Brazil is the world's largest sugar producer, followed by the European Union. Thailand, Australia and Cuba, the top 5 exporting countries, make up almost 65% of the world total exports. Australia's dependency on its sugar exports is much higher than that of any country. It exports over 75% of its total sugar production. To understand what drives sugar prices, you first have to realise where it comes from. In fact, it's produced in over 100 countries around the world, but it's grown in 2 forms. Most of the crop comes from sugar cane, which grows in tropical and subtropical areas, with the major producers being Brazil, India and Cuba. But 20% of sugar production comes from sugar beet, grown more in the northern temperature climates. Beet is a little bit more expensive to produce because of the different climate requirements. Countries mainly grow one or the other. The United States is the exception to this, growing cane in Florida, Hawaii and Louisiana, and beet in Minnesota and California. The sugar markets of the US and Europe are subsidised, giving producers prices that are higher than the world market and distorting the figures. Another recent occurrence that's affected the world sugar market is the increasing use of ethanol as an alternative fuel. While the US has toyed with ethanol, also grown corn for its production, it has not found a viable economic model. India is the largest consumer of sugar in the world, due partly to the growing use of ethanol as an alternative fuel. The demand for sugar is heavily impacted by population growth and income levels, and so links to long-term political and population trends. As the population of developing nations receives and gets accustomed to increasing income levels, this greatly increases demand for sugar. The major sugar importers are the United States, Germany, Great Britain and the former Soviet states. What does the future hold for the price of sugar? Like any investing, the greater your knowledge of the instrument you want to trade, the better your chances are of success, especially long term. One thing that will always remain completely unpredictable is the weather. If India was to experience a difficult monsoon season, then this could alter prospective sugar yields, making the commodity more favourable to investors eager to take advantage of any price increases due to falls in supply levels. But if the weather occurs in a seasonal manner, it affects sugar prices in a predictable way. During the harvest times, prices tend to fall. Sugar beet is harvested in the early autumn, before it's exposed to frost. That responds to November to February by the time the beet is processed. But the beet is replanted for the next year just when cane is being harvested. So prices remain weak from March through to May. After a couple of months of growing, the future supply is normally assured by July, when the sugar beet has matured. So prices again decline through August. The strongest time for sugar is just after planting, when it's most at risk.